Okay, so just a little chat through two partnership account questions. So we've got a lot of information on a partnership account question. So why don't we just highlight a few key things? So we've got Sue and Tom being in partnership for many years. The financial year ends 31st of January, and they've got a new partner joining on the 1st of September. So we've got the following information from the deed of partnership. So we've got all the interest on capital, salaries, and profit sharing for when it was just Sue and Tom, and then how it's changed when Uzma joins. It's really important that we look at all the information in these 14 mark questions. They're what we call AO2 questions, so there will be some information which we don't need, but they're also we need to deal with what's there and what's relevant. So if we look at it, the 1st of February, we've got the opening capital balances. Apologies for my wonky highlighting. Trying to use the mouse unsuccessfully, and so they obviously for interest and capital we would use that, but only until the 1st of September. So you got a period of time from the 1st of January to 1st of February to the 1st of September. Now what helps us with this is if you look at the question, it says prepare the appropriation account for the 31st of January 2021. Clearly show all the relevant figures for the 7 months before Uzma joined and the 5 months after, 14 marks. So basically the original capital figures will help us to calculate interest and capital for the first 7 months. You don't even have to get your fingers out. How many months is it? It's telling you. So you've got the first 7 months and then you've got the remaining 5. So for the remaining 5, you're going to have to look at what the capital balances are and how they've changed with Uzma joining as a partner. Now, one way they've changed, Sue was paid an additional £25,500 worth of capital. Realistically, what you have to do is create capital T accounts with the opening balances from point 1, and then you need to adjust them so you can calculate interest and capital for the second part of the year. The second part of the year is where most of the marks are for interest on capital. So what's happened is Uzma's paid 21,000 as capital investment. So that needs to be on the credit side of her capital account. I'll show that in a moment. But we've also got goodwill. Now, goodwill was here for a reason. Sometimes students will just ignore it. But that £54,000 worth of goodwill will be dealt with when we actually introduce the new partner. So it's part of the method marks to get the interest and capital for the second 5 months of the year. Point 5 tells us that profit was £100,500 and profits accrue evenly. What that means is you're going to need to work out the profit for the first 7 months as a 7-12 split, so divided by 12 times 7, and then for the second part you can do the same, but obviously multiply it by 5 instead of 7. It's told you the drawings. Drawings do not go in an appropriation account. That's something they put in there to try and get an alien figure, so something that shouldn't be in the appropriation account. And you are not creating a current account, but they will be relevant for the 6 marker. There are no interest on drawings. Interest on drawings only exist if they are listed on the deed of partnership. They're not there. Some students will calculate 5%, getting confused with the 5% interest on loan if it was an informal partnership and one partner had invested more capital. This does not apply here. Let's have a little look at the mark scheme. So I think if we look at how the marks or how the figures are calculated first. So Tom had a salary of £24,600. Now that's for a year. So we've got to do 7/12 for the first part of the year, so 14,350, and 5/12 for the other, £10,250. You will get a mark if it's included in the appropriation account with the correct numbers and deducted from profit, because that is one part of how the profit generated for the year is shared with the partners. Interest on capital. So we've got the first part of the year. Sue had £45,000 worth of capital, 6% interest on capital, and is 7/12, so 1,575, and the same for Tom. There isn't really any own figure here. You've got to calculate correctly and split the months. If you don't, you'll get nothing, and then you deduct those from profit in the appropriation account, which we'll show in a moment. For the second 5 months, it's a little bit more complicated. So they've put add and minus. For me personally, that's not really the method to use. You need to use a T account so you can demonstrate your understanding of what's happened. So we put our brought down figures in for Sue and Tom. We put in Sue's figure of 25,500 additional capital. Too many students put 25,000. I don't really know why. They're not reading the number, but you need to do that. You'll gain an additional mark, as it shows here, for adding the 25,500. Uzma's investments there. And then we introduce goodwill. So we introduce goodwill on the old profit sharing. So that was equal. So 50-50 for Sue and Tom. So that increases their capital balance by 27,000 each. And then remove it on the new profit share. So the new profit share, which was 35% for Sue, 40% for Tom, and 20% for Isma. So we remove it and do a debit side here. If you have included the goodwill introduced and removed, you're going to get 1 mark for doing that. But if you just get the correct balance brought down using those T accounts, you're going to get 2 marks for Sue, so 2 marks, 1 for introducing the capital, 2 for introducing and removing goodwill, 1 mark for Tom for introducing and removing goodwill correctly, and 1 mark for Isma for the same. So once you've got those figures, what you've then got to do is calculate the interest on capital. So this is own figure. So if you did not have those 78.6, 89.4, etc. as your figures, you could still get a mark for interest on capital, but you'd have to show your workings. Too many students do not. So you need to show how you get to the 5/12ths. So you need to do 4% times 5/12ths. That's the figure. You have to have workings. Doesn't matter if it's own figure, doesn't matter if it's right. If there's no workings and it's not the absolute correct figure, what I mean by right is it's right on your own figures if you haven't got workings. So the ones you wanted were 1,310, 1,490 and 125 pounds based on those capital figures. Once you've done that, you've then got your residual profit, which I'll show you the actual layout in a moment. But after you've deducted interest on capital and deducted salaries, in the first part of the year, it's 39,760, which is split equally 19,880 for each partner. And then for the second part is 28,700, and then we do the 35, 40, and 20% split. So they get 10,045, 11,480, and 7,175 respectively. So if we look at that, this is how it looks. So profit for the year very clearly stated with the 7/12ths and 5/12ths. 5/12ths, interesting, 5/12ths. The salary split that we discussed, the interest and capital. So you've got the first 5 months quite clearly illustrated, and the second, did I say 5? 7 months I meant. The second 5 months clearly put there, and you can see they are worth 7 marks. So half the marks in this question are for the interest and capital for the second part of the year. You then get a mark for working out the residual profit for both their own figure. As long as you haven't put anything weird in there like drawings, you'll be fine. And then you've got to show you understand how to share profits. Like we said the figures, so you get 1 mark for the 50-50 split of your own figure for profit available, and then 1 mark for the percentage splits discussed on the other one. That gets you up to your 14. So lots of methods we need to think about. 1, what the question is asking us for, but 2, how we can use the different points in the question to attempt it. What is it not telling us? We've got to think about in this instance, the capital accounts to help us work interest and capital. The information is there for a reason, and we need to determine why. Linked to this question was a 6 marker. So on joining the partnership, Uzma noticed that Sue and Tom maintain separate capital and current accounts. Uzma would like to change this so each partner has a combined. Now assess whether they should make this change. And the key thing, what is a current account? What's a capital account? So a current account is an account that shows the short-term movements for the partner. So it shows the profit share, the amount of drawings they've taken, interest on capital, salaries, etc. Capital is a fixed account, pretty much a fixed account, which shows the investment that each partner has made and is only really impacted by if they leave, retire, or if there's a goodwill valuation when either of those occur as well. I've put the levels there, but if we look at it, level 3, judgments are fully supported by a wide range of evidence, clear and balanced. Essentially what this means is you need an argument for this. So why should they have a combined capital and current account? Why shouldn't they? Fully supported by evidence, you need some figures and information from 8.1. If it's partially supported by evidence, there's some, or unbalanced, it will be in level 2, so 3 to 4 marks. And if it's unsupported by evidence, irrespective of how good it is, the maximum you're going to get is 1 to 2 marks because it's unsupported by evidence. You've got to use figures and information from the other question, no matter how good your response is. If it is not got any application, you will get 1 to 2. You get 0 if you just haven't got a clue. So if you don't know anything about it, then clearly you're going to get 0 marks. But evidence, balance, evidence, judgment. Argument for, argument against, using evidence, preferably figures if you can, and then a judgment should they do this. So looking at the mark scheme, the answers might include why you would do it. So the additional work is required to complete both accounts, which is time consuming. So maybe just having them combined is better. There may be some partners you don't really understand what it means by a current account, so they might think it's a bank account. That can lead to complications within the business. You could argue either those, or we go against it. So we wouldn't really know what the capital injections are, so it would be difficult to calculate interest on capital. So you'd have to do additional calculations to get there. We want to keep profits separate so we can help to work out our profit sharing. We want the current account as a fluctuating working account, so we know really how much we should take out in drawings. And it helps us to see if we've taken out too much. If there's a debit balance in the current account, we know that one of the partners will be taking out too much, and therefore we could potentially discuss interest on drawings as a measure to try and put them off doing that. If we look at the right hand side, so we actually can see that some of the partners are taking out more drawings than their profit share. So Uzma is taking out 10,000 and has a 7,300 share profits. So is the whole motivation of her wanting those separate accounts because of that, because she wants to hide the fact that she's taken out more? Maybe. And so that's something you could use, and there's a strong piece of evidence that you could use to support the separation and having a separate current account. So it's quicker to find those figures as well. So there's lots of information there, but balanced evidence judgment, you'll get a good mark on your 6 markers. Please remember evidence. Too many people are forgetting evidence. Okay? And good luck.